Last week, markets around the world hit their roughest stretch since April, so I thought it might be helpful to highlight 5 themes and takeaways we observed. Now, just to set the scene, in the US, both the S&P 500 and the Dow fell around 1.8%, while the tech-heavy NASDAQ dropped nearly 2.7%. Small caps held on a little bit better, but the Russell 2000 was still down nearly 0.5%. Now, the first and perhaps most talked about theme this week was that of AI euphoria transitioning to AI anxiety. AI stocks finally hit some real turbulence. Nvidia, perhaps the biggest star of the AI boom, crushed earnings again with record revenue and a strong outlook. Normally, that would spark an unrelenting rally. Instead, the stock flipped from being up around 5% in after hours to closing down around 3% the following day, and the entire market fell with it. So what's driving the shift? Well, for a while now, investors have been asking, is the massive spending on AI actually going to translate into profits, and when? It appears that this week that anxiety finally materialized in the market. Now, markets aren't saying no to AI, and Nvidia is still up almost 30% this year, but investors are pushing back on the idea that the payoff is guaranteed or imminent. There is a clear rotation toward companies like Alphabet that are monetizing AI now, rather than those focused on far-off breakthroughs. One thing I found really interesting this week, Anthropic announced a new partnership with NVIDIA and Microsoft. In past months, these types of announcements have provided a strong boost to participant stock prices and been heavily discussed, despite being viewed by some as relatively circular. However, the announcement this week came with very little fanfare and certainly no positive price movement. So from all of this, I take away that investors are definitely disenchanted by the AI trade right now. AI may or may not be in a bubble, but at the very least, for the first time this year, investors are treating the sector with caution instead of blind enthusiasm. Now, a second theme we saw was a ripple effect of the growing risk-off sentiment impacting the larger tech sector and crypto. The AI wobble triggered a broader risk-off shift, and crypto saw its worst sell-off since the 2022 crypto winter. Bitcoin futures broke into oversold territory, and crypto-linked equities, including MicroStrategy and Coinbase, took heavy damage. Now, part of this was mechanical. Big tech investors very often also hold crypto, and when tech drops, they sell crypto to cover losses. That adds fuel to the downside, helping create the kind of violent swings we saw all week. The third theme we took away, the Fed's December decision is still relatively up in the air. When the delayed September jobs report finally dropped, it told a mixed story. Job creation accelerated while unemployment rose to 4.4%, a 4-year high. Investors are still trying to figure out whether the Fed will cut rates at their final meeting of 2025. Odds of a cut jumped nearly 70% on Friday, helped by comments from New York Fed President John Williams, suggesting that the door is still open. But other Fed officials this week also expressed the opposite opinion, and the Fed minutes showed skepticism about cutting so soon. So this uncertainty has obviously contributed to the greatest market volatility we've seen since April, with the VIX staying elevated and intraday swings getting increasingly dramatic. The fourth takeaway I would note was surprisingly rosy. The consumer is more resilient than most expected, and many retailers are quietly thriving. In contrast to all the market angst, American consumers are still spending. Retail earnings from Walmart, Gap, TJ Maxx, and Ross all pointed to a surprisingly strong holiday season ahead. Discount chains are thriving as shoppers hunt for value, and even high-income shoppers are migrating to Walmart for deals. The National Retail Federation sees holiday sales rising 3.7 to 4.2%, so similar to last year. So it's hardly a consumer recession right now. And this resilience is perhaps one of the reasons markets haven't fallen even further. The last takeaway I would highlight: some investors believe that last week's pullback and sector rotation was actually really healthy. After a 38 to 40% rally since April, many felt that the market was a little too quiet, and this month's 4 to 5% pullback is actually the first real reset in nearly 150 days. Generally, pullbacks of that size happen a couple times a year. So we saw clear evidence of rotation. Money moved out of stretched mega cap tech and into defensive sectors like consumer staples and healthcare, which both outperformed for the week. So perhaps this wasn't panic, it was portfolio rebalancing. Bottom line, it was a messy week, but maybe it wasn't a market breakdown. Perhaps it was just an overdue reality check.